A debt crisis appears imminent. In October, the U.S. kicked off the fiscal year with a record deficit of $284 billion, dollars, the worst start ever recorded in history. What is driving this slow moving crisis and how will it be fixed? So, goodbye, Doge. It was fun while it lasted. We are hurtling toward a debt crisis once again. We are getting monthly Treasury statements from the Treasury Department now that the government's reopened, and it is very ugly, as we will see. Now, remember, the start of fiscal year 2026 is October. The fiscal year runs October through October. So we're looking at the start of fiscal year 2026. Over here is revenue by source. The vast majority of government revenue comes from individual income tax, $217 billion. Here's spending by source. We can see that the vast majority of spending is Medicare, Social Security, defense, and interest. Now, by the way, spending is about $23 billion per day. If we compare October to October, revenue is up, yes, 404 relative to 326 billion last October. However, spending is up even more, 688 billion relative to 584 billion. The deficit is growing at about 11% year over year rate of change. Now, debt issuance, remember, the deficit is the difference between spending and revenue. Well, how do you cover that gap? You issue debt. That is why the deficit matters so much. It is new debt that must be issued every single year just to keep the lights on. Debt issuance actually grew at 11.4% year over year rate of change. Here, by the way, is a way of visualizing that revenue in green, spending in blue. Both are up. Spending is up more. Deficit is up to a record, actually, as we will see in a second. Here's revenue by source as a pie chart and a bar chart. Here is spending by source as a pie chart and as a bar chart. Now, moving on to this, which I think is really what shows the issue, along with some of the charts that we will show in a second. Individual income tax grew at 6%. Gross corporate tax only grew at 2%. So you are paying more. Meanwhile, corporations are paying less. By the way, Federal Reserve earnings, zero. They marked a $1 billion profit. Mark that in your head because we're going to take a look at a pretty mind-blowing chart in a second. Customs duties, or that tariff revenue, right now averaging about $350 billion per year. Now, I will keep pointing out that is enough to eliminate the income tax on the bottom 75% of income earners. By the way, tariff revenue grew at 316% year over year rate of change. Health and Human Services grew at 50% on an unadjusted basis, but due to calendar issues on an adjusted basis, it grew at 2%. Interest on the debt, however, grew at 27% year over year rate of change. The interest on the debt last October was 82 billion and it is now 104 billion dollars. The interest is really one of the main drivers of this debt crisis we are in. Veteran affairs spending grew at 62% on an unadjusted basis. However, due to those calendar issues, on a 10% calendar adjusted basis. Social Security Administration grew at 11% compared to last October. And of course, the deficit, as we noted, grew at 10% year over year rate of change. Now, those Fed earnings that are supposed to be remitted back to the U.S. Treasury Department, they are actually operating at a $243 billion loss, the Fed. And they get to mark this as what they call a deferred asset. It is pretty mind-blowing that they are able to do the accounting tricks that they are. Here we can see tax revenue as a share of GDP. We can see that has been relatively constant from about 15 to about 17% of GDP, but basically growing in line with GDP. When you have the numerator growing at the same rate as the denominator, the line will go sideways. It'll be horizontal. However, government spending has grown more than twice as fast as the total U.S. economy, as GDP. It has gone from 11 or 12% of GDP back in 1950 to now 23% of GDP. So we do not have a revenue problem. That is growing in line with GDP. That is staying relatively constant. The issue is the spending side. So here's the fiscal deficit as a share of GDP. Remember, the fiscal deficit, that is net new debt. that must be issued. GDP, you can think of as a rough proxy for the kind of balance sheet capacity to absorb that debt. Right now, the nominal deficit is about $2 trillion per year, expressed as a share of GDP. That's 7% of GDP. We have gone from a 3% budget surplus back here in 2000 to a 7% of GDP deficit, despite the fact that unemployment has been basically flat. Headline U3 unemployment has basically gone nowhere. And yet we have gone from a 3% budget surplus as a share of GDP to now almost a 7% of GDP deficit. This is why. So here we can see the relative increase, percentage change going back to 1971 of these various different components: Social Security, interest, Medicare, defense spending, and GDP. GDP has grown about 3,100%. The problem is interest, Social Security, and Medicare, Medicaid as well, but TradingView doesn't have that, have grown far faster. In fact, Medicare has grown almost 7 times faster than the US economy. Remember, tax revenue for the government is dependent on GDP. Remember, the government can really, at the end of the day, only tax GDP. So they need the overall pie, GDP, they need that pie to grow bigger because the government is taking the same size slice from that pie, as we could see from the white line here. The government's taking the same size slice from that pie, so they need their pie to grow bigger. The problem is Social Security, interest, and Medicare are growing far, far, far faster than the pie, GDP, is growing. Now, not only that, but of course, interest, defense, Medicare, Social Security, those 4 items that I always harp on, those alone are basically 100% of government revenue, just those 4 items alone. Now, you might be going over here to the 1980s going, well, yeah, but it reached 115, 120% once before. Yes, but debt to GDP was about half of what it is now. It is not 124%. Back then, it was about 70%. So 100% of tax revenue just to fund those 4 things: interest, defense, Medicare, and Social Security. That's it. Now, here we're looking at it as a share of GDP. So Social Security has grown far faster than GDP. Medicare has grown far faster than GDP, up and to the right. Interest as a share of GDP has grown far faster over the past 5 years or so. Obviously, we were in a bond bull market with falling rates, so our interest as a share of GDP was actually declining here because we had QE and ZERP and artificially low interest rates from a 50-year bond bull market. Now, here we're looking at those 3 items as a share of revenue. And I think that this is probably the best way to think about it. So Social Security has gone from 12% of government revenue back in the late 1950s to 30% of government revenue. If you look at Medicare, it's even worse. That has gone from about 1% of government revenue to 24% of government revenue. Interest, again, fluctuate. We had high interest rates back in the 70s, so we have not reached that peak yet. As a share of government revenue. Currently, about 23 cents out of every dollar that gets paid in tax revenue goes to funding the interest on the debt, which is about $3 billion per day in terms of the daily interest on the debt. 3 billion with a B. Now, how will they fix it? They will fix it the way that governments always try to fix it, which is keeping nominal growth rates higher than the cost of the debt. That is what we're looking at down here. The dotted red line indicates 0, indicates the 10-year treasury yield, or the cost of the debt, is the same as the nominal growth rate. Remember, nominal growth includes inflation. So one of the ways to boost nominal growth, to run it hot, is to boost inflation. That'll get nominal growth up. Right now, we can see the 10-year treasury yield is about 1 percentage point below our nominal growth rate. Now, debt to GDP, if you can keep the cost of your debt below nominal growth, debt is really not too big of an issue. However, when the cost of the debt rises above your nominal growth rate, that is when you have issues. By the way, generally that occurs during a recession, as we can see from the shaded red areas. Yield curve control, again, is probably, or some form of QE is going to be necessary, because this administration clearly wants to run it hot. spot, but then you're going to have the 10-year treasury yield and the 20 and the 30-year. Those yields are going to go higher. If you say we're aiming for an 8% nominal growth rate, well, 10-year treasury yield's not going to be 4%. So they're going to need to QE. Anyways, hopefully that was helpful, and I'll catch you in the next one.